Okay, dear students, I hope I'm properly audible to everyone. Let me check. According to the system, yes, I'm audible. Rest, you people can decide. Am I audible? Okay. First of all, welcome to a very first day of our PM crash course. Number one. Number two, in this PM crash course, student will be discussing every question which we'll be discussing in this crash course. That question is going to be from the study hub. Plus, when I'm going to discuss PM pre-scene mock, I will announce that as well. So I will obviously give the opportunity to my students that you can also attend live class where I'll be discussing the ACCA pre-scene mock of PM. Okay. But here, each and every question which we'll be discussing in PM crash, it will be from study hub number one. Number two, through questions, okay, students, I will try to give you the revision of entire PM. Today's target is to cover through questions, okay, to cover around 2 chapters. And today is the first class, so it will not be so long, but definitely the class which is coming 2 classes, they are going to be long. Definitely they will be long. And plus today's video, there's a possibility we might upload that on our YouTube channel, but the remaining 2 videos will not be uploaded on the channel. They will be only uploaded on the portal available to our enrolled students. Okay. And I'll give the opportunity of you can attend our PM, I would say, pre-scene mock discussion class as well. So let's start from a very first question. And I've started in a different way. Let's see the first of all is to transfer pricing. Actually, when do we apply transfer pricing? Whenever an organization is working in divisionalization form. Now, what is this divisionalization form? For example, we are having a ABC company, and this ABC company is having, let's say, division 1, division 2, division 3. All the divisions, of course, they are working for ABC company. And ABC company has given the independence to division 1, division 2, and division 3. So ABC companies manage the way they are managing, they are following the system of divisions, and each division is given independence. For example, the product which D1 is producing, assuming that product D1 could sell in the market, as well as D1 can sell the same product to D2 and D3 as well. Similarly, the product which for example, D2 is going to buy from D1, D2 could get the product from the market. So transfer pricing issue will only arise when number one, the entire company is managed through, I would say, divisions, where divisions are given independence, authority. And obviously, each division is working for the same company. Then there is a transfer pricing issue comes because when D1 is going to sell the goods to D2, let's say output of D1 could be input for D2. When D1 is going to sell the product to D2, even though D1 can sell the product outside the company as well, the question arises that when D1 is going to sell the product to D2, at what price D1 should sell the product to D2? Here actually we'll be using transfer pricing. But of course, what will be that transfer price? It will vary situation to situation. Because when D1 wants to transfer, or D1 can transfer, can sell the goods to D2, and we know that D1 can sell the product in the market as well. So we have to see, there's a possibility that even after selling the product in the market, D1 might still be having the free capacity, idle capacity, which could be utilized to make the product for D2. So we have to see the situation of D1. There's a possibility that D1 is already is already the plate of D1 is already full. D1 does not have a time to manufacture any product for D2 because he's 100% engaged for fulfilling the demand of their customer, which are outside ABC company. So we have to. It means that there is no rule of thumb that one transfer pricing will be applied every time. That is not possible. So we have to see in which situation what transfer pricing is going to be there. Plus, the main concept is when does this transfer pricing issue arises? when entire organization is managed through divisions, and divisions, we have given independence to the divisions. Okay, then obviously we think about and we talk about this transfer pricing issue. But whatever transfer pricing we are going to keep, at the end of the day, you need to make sure that entire ABC company should get the benefit. If due to transfer pricing, the profitability of the entire company reduces, then such transfer pricing is not recommendable at all. But one more thing, for example, D1 could sell the product in the market for $20, but the same product when he's going to sell for D2. So D1 has to consider there's a possibility when D1 is going to sell product to D2, there's a possibility D1 might not be bearing the same transportation cost which D1 bears when D1 sells the product outside the market. So this factor D1 cannot ignore, because if you ignore that factor while deciding the transfer pricing, then it makes it is not logical. Then you have to consider that factor as well. Plus, there's a possibility you might be bearing any other cost also when you are selling outside the company. Maybe you might be bearing any legal cost when you are selling outside the market, outside the company. But if you are selling within the organization, if you're not bearing such cost, so you have to consider that as well when you are deciding the transfer price. If you have the spare capacity, you have to consider that as well when deciding the transfer price. If you obviously does not have a spare capacity, and you are making products for D2, so you have to consider that as well, that we are already working at full capacity. So in different situation, we'll see what is going to be the transfer price. But at least I've given one concept. When do we go for transfer pricing? When the entire organization is managed through divisions, and divisions, they are given independence. Okay. Now come here. Look at the very first question. What transfer price per unit will result in profit margin? This is also important. Some student, sometimes a little wrong interpretation of the requirement, simply you will end up by losing easy 2 marks. So make sure you should be able to 100% understand what exactly examiner is asking. The term which examiner has used is profit margin of 20% for division X to the nearest dollar. Profit margin. Now come here. Let's go to the basic. Cost plus profit is equal to selling price. When my examiner says margin, student, margin is a percentage of revenue. Whenever my examiner says margin, in case of margin, my selling price is 100%, which means that if I want to generate margin of 20%, I want to earn margin of 20%, it means my cost is 80%. It looks very simple. That's why we know that in margin, the selling price is 100%. But sometimes things which we assume they're very easy, if we just slip that easier thing also while sitting in exam, then obviously we'll end up by making mistake. Like instead of margin, if the word was markup, things will change. Students, markup, when we say markup is a percentage of cost. In markup, what happens? Cost plus profit is equal to selling price. In case of markup, the cost is 100%. For example, company wants to earn markup of 20%, then your selling price will be 120%. It means that you have to read the question requirement properly. Either the term which examiner has used, it is margin or markup, because in both the cases, relationships are different. The question which we are right now reading, this question says margin. Margin means your selling price is going to be 100%. And logically, your total cost will be 80%. Now let's come here. Conference company has divisionalized structure. We have already decided this concept, that transfer pricing issue will only arise when you are running your company in divisionalized structure. One of its divisions is division X, sells all its output to other divisions within the company. Okay, fine. Division X, annual budgeted output and cost are as follows. Units sold 1050, they are the units sold. Direct material 22,500, direct labor is 45,350. Other overheads, and within this other overheads, 40% are variable, it means 60% are fixed. 37150. Now the question is very simple. They are asking us to calculate transfer price where the margin has to be how much? 20%. So simply what I'm going to do, let's take direct material cost, direct labor cost, and overhead. We'll get the total cost. Let me use the calculator. 22,500 plus 45,350 plus 37,150. Students, I'm getting 1,05,000. So the total cost is 1,05,000. Total number of units sold are 1050. If we calculate cost of one unit, so that will give us the cost of one unit. Let me calculate that. Student, cost of one unit is 100. Cost of one unit is 100, and we need to calculate the transfer price, selling price, where margin is actually 20%. It means now if you come to the equation, in case of margin, we know that your selling price is 100%. If margin is 20, it means cost is 80%. Now listen, we need to calculate transfer price, means here we need to calculate selling price. Cost of one unit is $100. Cost of one unit is $100, and we know that due to margin of 20%, cost represent 80%, and selling price represents 100%. So I have to bring this 80% cost to 100% selling price. You just need to multiply this with 100 divided by 80. Students, I'm getting 125. So basically the transfer price, selling price is 125. So you need to know the relationship when the examiner says margin and when examiner says markup. It was margin. So 125. Now come here. Which two of the following bases for setting a transfer price are most likely to result in goal congruent behavior by both selling and receiving division? Goal congruent means at the end of the day, make sure you follow the system of transfer pricing. At the end of the day, we should give the benefit to the entire organization rather than to one or two divisions. Which two of the following bases for setting a transfer price are most likely to result in goal congruent behavior by both selling and receiving division? Number one is opportunity cost. That makes sense. If I'm a selling division, if I have any opportunity cost while deciding the transfer pricing, I cannot ignore that opportunity cost. Why would I ignore it? Makes no sense. Okay. Then it says which two of the following bases for setting a transfer price are most likely to result in goal congruent. Look at this. The third one says actual cost. Uh, I'm not considering this standard full cost. I'm considering the market price. Now, why market price? For example, I am a division. I manufacture one product which has the market value, which has a market demand as well. If my product is having a market value and it has a demand as well, if I can sell in the market, then obviously while selling the same product within the organization, I cannot ignore that market price. An examiner has what exactly examiner has asked? Okay, which two of the following bases for setting a transfer price are most likely to result in goal congruent behavior by both selling and receiving division? Actually, if we consider actual cost, for example, the selling division, whatever selling XYZ price selling division wants to charge. If the buying division says, I will pay you just according to your actual cost, so obviously the selling division will say, what is the benefit, what benefit I will get it. It will become very difficult to convince the buying division to the selling division, because selling division will not agree selling the product at actual cost. When it comes to standard full cost plus what? Now, if you are saying, for example, the seller says, I will charge you the transfer price, which will be standard cost plus markup or margin. The question is the price which will come after adding that profit element. There's there is a greater chance that that might not be acceptable by the buyer. So out of these four, actually first two, they will actually result most likely. We're not saying 100%, but most likely they will result in a goal congruent behavior by both selling and buying division. Okay, let's see this one. If division B accepts cold company's offer, now what is the offer? What will be the effect on the profits per year of the Oxco group? Student, first read the requirement again. If division B accepts, if division B accepts cold company's offer, what will be the effect on profit per year for the Oxco group? Obviously, after accepting their offer, either the profit will increase or decrease. Let's read the question. Oxco has two divisions, A and B. Division A makes a component of air conditioning units that it can only sell to Division B. It has no other outlets for sales. Okay. Oxo company has two divisions. One is A, another is B. But something interesting is happening. Division A makes component for air conditioning units that it can only sell to Division B. It means that if Division B can get the same thing outside the company, can I say in that case you have to close Division A? Why? Because whatever Division A manufactures, Division A can only sell it to Division B. What if Division B becomes in a position to get the same thing from the market but at a lower price? So if this is the case, I'll end up by closing the Division A. Current information of Division A is as follows. But marginal cost means variable cost. We know that which is always relevant. $100. Transfer price of the component. Now this is important. How much transfer pricing Division A is charging? 165. Total production and sale of the component of each year is 2,200. Specific fixed cost of Division A per year is 10,000. Now listen to this, student, nicely. Specific fixed cost, another name could be directly attributable fixed cost. So actually specific fixed cost of Division A means if we are running the Division A, we have to bear $10,000 fixed cost per year, which means that if we close Division A, then we are not going to bear this specific fixed cost of Division A. Repeat. Specific fixed cost means if we run Division A, then we have to bear per year $10,000. It means if I close Division A, at least I'll get one benefit, and that one benefit would be that we are not going to bear this $10,000 specific fixed cost. Okay. Coal company has offered to sell component to Division B. Wow, wow, wow. Coal company has offered to sell the component to Division B for students 140 per unit. And right now, Division B is getting the same product from Division A. For how much? 165. Means, actually, let's take the Division A and B, both are divisions of Oxco company. Let's take Oxco company is the parent. Okay. A and B both are son. One son is selling, or you can say one brother is selling to another brother for 165. But the same thing now. could be taken from outside and someone else is offering 140. Okay. If division B accepts this offer, if the brother B accepts this offer, then division A will be shut down. Simply the business of division brother A will be shut down. So we have to see. Either accepting this offer will be acceptable or not, but now we will have to see from the company's point of view rather than the division point of view, because don't forget one thing, at the end of the day, transfer pricing objective is at the end of the day, the entire organization should get benefit rather than one division. Okay. There's a possibility that one division is getting a benefit, but the entire company is facing a loss. So such a transfer pricing or such a decision is not acceptable. Like there is a possibility that if brother B accepts 140 offer of buying this product outside or not buying this from his brother A, it might be beneficial. It looks beneficial for brother B, but the problem is another brother business becomes zero. So parents will have to see that should we accept this offer or not? Because at the end of the day, we have to see entire family, entire company should get the benefit. So let's try this now. Now try to understand. If division B accepts cold company offer, what will be the effect on the profit per year for the organization? Now listen is nicely. Marginal cost means variable cost of manufacturing this product is $100. If we go outside the company, we'll be paying 140. How much additional will be paying against the per unit? Can I say additional per unit will be paying 40? So 140 minus 100. If you go outside the company, so you will end up by paying $40 additional per unit. And how many units are there? 2,200. Let me use the calculator. Student, the variable cost, you can say that variable cost for the entire group will increase by 88,000. The story does not end here. Of course, when division B accepts the offer from this supplier, which is cold company, we have to close the division A. If we close the division A, company is going to save $10,000. So 88, they have to bear the additional cost, but simultaneously there will be saving of fixed cost, because if we buy the same product outside the company, we are going to close division A. By closing division A, we will save $10,000. So can I say, at the end of the day, entire company's profit will reduce by 78,000. Is that clear, student? Kindly reply. Entire organization's profit will reduce by 78,000. Now, this might be beneficial for division B only, but it is not beneficial for the entire group. Like it is beneficial for division B. It is beneficial for this brother B, it is beneficial to buy the same thing outside the group. But by doing this, it is not beneficial for the entire family. At the end of the day, entire family will have actually will reduce their profitability by 78,000. So logically, there is going to be a decrease, and that decrease will be of 78,000. So it means that just something which is beneficial for one division does not mean that we are going to accept that offer. In transfer pricing, student, I've already told you, at the end of the day, we have to see the decision must be beneficial for the entire organization rather than just one division. Now look at this. What transfer pricing per unit will generate a desired divisional profit 10% on sale? 10% on sale. Student, whenever profit is a percentage of revenue, it is a margin. Or in case of margin, we know that cost plus profit is equal to selling price. We know that your selling price is 100%. If margin is 10, it means the cost is 90%. And go to the two decimal places. So student, I want every one of you to attempt this question, and let me take your questions as well. decrease 78. Thank you. I'm giving you 2 minutes. I want every one of you to attempt this. And student, whenever the opportunity is provided to you to attempt, then kindly you should attempt. You have 2 minutes to attempt this question. A company has budgeted to produce 30,000 units of product in one of its division. Total costs for the division are expected to be direct material 52,000, labor is 77. Again, 40% variable, 60 fixed. So simply total cost we can calculate. 52,000 plus 77 plus 28. Students, I'm getting 1,57,000. The budget is 30,000 units to produce. Total cost is 157. So that will give us per unit cost. Students, per unit cost, I'm getting 5.23. Okay. This 5.23 is actually 90%, and we need to convert this into 100%. Let's take 5.23. 100 upon 90. That will give us the transfer price, selling price. 5.81 is perfect, and majority is correct. Great. 5.81 is correct. Question number 5. What is the minimum transfer price that divisions sell should accept for transfer pricing component XBD to division by? What is the minimum transfer price? The division cell will say, at least I need this much. I want every one of you to attempt this. Again, you have 2 minutes. Let's see who will answer. Okay, let's see. Students are applying. Let's see. Okay. So far, one answer is 7.5. What about others? Okay. Majority of the students, they are going with 7.5. Let's see. And students, I hope you people know that today, Alhamdulillah, we have completed our crash course of taxation. And just by spending, I would say, within 6 to 7 hours, in fact, within 6 hours, you can revise the entire taxation. That is the, I would say, finest, best crash course in the entire world. And ATX is going to be completed tomorrow, where just by spending 9 to 10 hours approximately, you can revise the entire ATX. Okay, what is the minimum transfer price? Let's see. Division cell is operating at full capacity. Okay. Producing component of XBD2, which it sells externally for $8 and works at full capacity. Okay. It means that when I'm going to do the same job for another division, I have to stop I will not be selling my product outside. If I'm not selling my product outside, then I'll be losing the contribution which I could have generated by selling outside, because I'm already at full capacity. So the variable cost of production is $5, which means that by selling 1 unit, we are generating a contribution of $3. And we are working at full capacity, which means that if I'm going to sell the same product within the organization, then I will have to keep in my mind that by selling the same product outside the company, I can generate the contribution of $3. So logically, selling within the company, this $3 becomes my opportunity cost, and I cannot ignore that opportunity cost. Another internal division by is negotiating a transfer price for purchasing component X BD2 from division cell because of safe transportation. The variable cost of producing component XBD for division by would be 4.5 per unit. So it's okay. When I'll be producing the same product for another division, then my transportation cost will be safe. So simply my variable cost, instead of $5, my variable cost will become 4.5. So when I'll be selling within the organization, my variable cost will be 4.5 and my opportunity cost remains $3, which means the minimum transfer price on which I will accept, that is going to be the variable cost of manufacturing for another division plus the opportunity cost. So it becomes 7.5 variable cost of producing the unit plus opportunity cost, because we are working at full capacity. When I'm working at full capacity, I'm not going to ignore my opportunity cost. And of course, how can I ignore my variable cost? So seven students, C is the answer. And majority was having the same answer. Good. Good to see. Divisional performance evaluation. Okay. What is the company's return on investment? What is the company's return on investment? Okay, now listen. First of all, students, come here. Assuming, I'm just giving you one idea. Assuming we are running our business in a divisionalized structure, and Mr. Y, assuming is a head of division 1, okay? And Mr. Y is asking a very big bonus for his entire division 1. The question is why Mr. Y is asking a really big bonus. Mr. Y says, kindly listen to this. Mr. Y says operating profit generated by my division, and this is the division I'm the person who's responsible for the performance of division 1. I'm the person who monitors each and every move and action which takes place in division 1. I'm the person who executes all the plans in division 1. I am the person who makes all the decision, everything I'm responsible. And due to Mr. Y says to the director, due to my intelligence, due to my hard work, and my division 1 has generated a operating profit of $20 million. And Mr. Y says that makes me that I deserve a really big bonus. And Mr. Y is asking, give me at least, or not to me, to my entire division, at least the bonus of $2 million. Wow. After listening to the small speech of Mr. Y, one of the directors says, Mr. Y, how did you generate this 20 million operating profit? Mr. Y says again the same thing. By monitoring, executing plans, and this, that. Director repeats the question that how did you make this 20 million operating profit? He says the same thing again. Then the director says, Mr. Y, give us answer of one question. Mr. Y says, go ahead, ask the question. Director says, would it be possible to make the same amount of profit without the resources which company has provided you? Could you make the same profit of $20 million without the resources which we have provided you? Then obviously Mr. Y says, no, it's not possible. Then the director says, it means that you have utilized the resources to generate this 20 million profit. Without using those resources, it would have not been possible. Mr. Y says, yes. Now the company director says to Mr. Y that Mr. Y, listen to us nicely. Assuming in division 1, capital employed, or let's say net asset, capital employed, which company has given to Mr. Y, the amount of that capital employed is, I'm assuming, is $200 million. Wow. Logically, the resources which company has given to this division, amount of total value of those resources is 200 million. It means by utilizing the 200 million resources, this division has generated a profit of 20 million. Now one of the directors says to Mr. Y that Mr. Y, instead of giving you the resources of this 200 million, if We have not done this just to discuss with Mr. Y. Director says, if instead of giving you the entire 200 million resources, if you would have deposited that 200 million to a bank, let's say we could have generated at least 12% return on that. We are not saying that we have done this, we are just telling Mr. Y that instead of giving you the 200 million capital employed, if we would have deposited, for example, the same amount, and in 1 year's time, we would have generated 12%. Now, listen, I will deduct logically notional interest. $200 million into 20% or 12%. I think we are getting 24 if I'm not wrong. Yes, 24. Logically, if you look at this, at the end of the day, the way Mr. Y has utilized your resources, he has not utilized the resources of the company effectively at all. In fact, Mr. Y division is a loss-making division. If you look at the residual income, logically, residual income is there's no income. We are having a loss. After this argument, of course, Mr. Y will not be able to ask any bonus. Instead, there's a possibility Mr. Y might be concerned now about his job security. His eyes will be wide open that what he has done. Just 5 minutes ago, he was saying such big things, and now he's concerned about his job. So this is not the way that your division has generated an operating profit of 20 million and you start asking the bonus. You don't forget one thing. Whatever you have generated, it was only possible because company has given you the resources. So we have another way of actually monitoring the performance, evaluating the performance, and another way is residual income. How do we calculate residual income? From operating profit, actually we deduct a notional interest. The logic behind notional interest is instead of giving those resources to this division, if we deposit that amount to the bank, for example, how much we could have easily generated. Difference is actually your residual income. Okay. It could be, for example, if he generated 30, then it means logically the residual income is 6 million. So most of the, I would say, companies, they do evaluate performance of their division rather than return on investment. They go for residual income. Okay, fine. Now, if I want to, I have to calculate a return on investment. So calculation of return on investment is very simple. I will simply take the operating profit. If my examiner gives me the capital employed, I'll take the capital employed. Examiner gives me the net asset, I'll take the net asset. Operating profit divided by capital employed, or it could be operating profit divided by net asset. Whichever examiner gives us, I'll be using that to calculate return on investment. Okay. But you need to know one thing. If your examiner gives you the residual income and you have been asked to calculate return on investment, student, for calculating return on investment, we need operating profit. So if examiner has given you the residual income, then you have to add notional interest, or you can say imputed interest. Notional interest, you will get operating profit. So you should read the question properly. Either your examiner is asking return on investment or your examiner is asking residual income, plus look at the data as well. If I have been given a residual income, an examiner is asking me to calculate, let's say, calculate return on investment, then what I have to do? Now let's come to the question. A company has capital employed 300,000. Cost of capital is 10% per year. Residual income is 45,000. An examiner is asking us to calculate return on investment. Students, for calculating return on investment, first we need operating profit. So residual income is, okay, great. Residual income is 45,000. We will add, simply we need to add back imputed interest. Another term is notional interest. You can use any one of them. No problem at all. Imputed interest. 300,000 into 10%. That is your operating profit, okay? So here comes return on investment. 75,000 divided by 3 lakh into 100. How much? 25%. I think majority is having this 25%. Majority is having this 25%. Okay. Student, I want every one of you to attempt this question number 7. You have 2 minutes to attempt this. Kindly attempt this. Okay, let's try together. What will be the residual income of the division after the project is implemented? The northern division, okay, the northern division of GMS company, a games company, I would say, currently earns a return on investment 15.5%. They are already earning a return on 15.5% based on capital employed, which is 2.68 billion. The divisional management team has decided to implement a project which requires, we need to make an additional investment of 320. The project is expected to generate, your profit will increase by 53,000 per year, and the cost of the division is 13%. And we need to calculate residual income. And how do we actually calculate residual income? We need simply operating profit minus imputed interest. Operating profit minus imputed interest. So let's see. Already the return on investment is 15.5% on the capital employed of 2.680. Okay, fine. The return on investment is 15.5%. Capital employed, we already have 2680 triple. Now, very easily, I can calculate operating profit on this. How to calculate operating profit? Simply, I'll take 15.5% of capital employed. Let me take this. I'm getting 4,15,400. We have to go for additional investment. Additional investment will be 3,20,000. That additional investment will increase my capital employed. But my profit, they have categorically written, profit will increase by 53,000. Increase in profit, increase in operating profit is going to be 53,000. So this will be my total capital employed, and that is going to be total operating profit. Students, total operating profit, I'll be having 4,68,400. Capital employed will be 268,000,000 plus 320. 3 million. 3 million. Now we have to simply deduct imputed interest. How to calculate that imputed interest, notional cost? We are working for the northern division, and northern division cost of capital is 13%. Simply, I'll take that 13% on my capital employed. Let's take 13% of this. I'm getting 3 lakh 90. Here comes your residual income, which is 78,400. That's simply excellent. Majority was having the same answer. Great. Okay. Now, show. Simply attempt this question. Just read the data. Looks very simple. All you need is just calculate return on investment and residual income. You are just required to calculate return on investment and residual income. Melton Company has many divisions which it evaluates using return on investment and residual income measures. The Move Bray division has net asset 24 million. 30 September X4, in the year 30 September X4, it earned operating profit 3.6 million. The appropriate cost of capital for Move Bray division is 12%. It is company policy to use capital at the end of the year for calculating ROI and RI. During the 30 September, it is paid interest of 0.6 million they have paid. What are the ROI and RI? Return on investment. Operating profit they have given us is straightforward, which is 3.6 million. Operating profit is the profit before interest and tax. Net asset they will work as capital employed. Here comes straightforward your return on investment. Let's see what I'm getting. Student, I'm getting 15%. I'm getting 15%. Okay. Now let's talk about residual income. Operating profit they have given us. Student, from this operating profit, we need to just deduct the notional cost. Notional cost, notional interest, imputed interest. Net asset, they are 24 million. And cost of capital for Move Bray division is 12%. So we'll simply take 12% of this. I'm getting 2.88. 3.6 minus 2.88. I'm getting 0.72 million. So students, the residual income is 0.72 million. C is the answer. Again, I hope majority is having the same result, which is nice to see. Okay. Student, here they are asking simply, what is the return on investment of division D? So I really want every one of you to attempt this question. And I'm giving you around, let's say, 4 minutes to attempt this question. So every one of you is having 4 minutes. Let's see who will come up with the right answer. Okay, so let's try this question. What are they asking? This is again very important. They're asking, what is the return on investment for division D? Return on investment. Okay. I need simply operating profit divided by capital employed. If capital employed is not given, I'll go with the net assets. Division D currently has 2 million net assets. Now stop. Right now, examiner says we are having net assets of 2 million. 31st December and showing operating profit. This column we are taking for operating profit. Or you can flip it. Just no issue at all. Let's work like that. Net asset we have 2 million. Operating profit is 280. Okay, fine. No entries have yet been made for depreciation. Okay. But don't forget, students, the examiner has given us net asset. Net asset means total asset minus total liabilities. Okay. And they have categorically written that we have not dealt with the depreciation. And right now we don't know within this 2 million what is the amount of property, plant and equipment. Okay. However, the accounting records need to be amended for transaction in relation to non-current asset that took place on 30th December X2, just one day before year end. A machine with a net realizable value of 1 lakh, means net book value 1 lakh, was sold for 125. Now stop and keep watching what is happening. Disposal. Students, net asset will reduce by 1 lakh. First of all, what is this? Something is wrong with the battery. There shouldn't be something. Okay. Disposal. Students, we sold the machinery for 1 lakh. We sold the machinery which is having a net book value of 1 lakh. We sold it for 125. It means gain on disposal. Gain on disposal is 25,000. That will increase operating profit plus 100,000 net book value asset is leaving my books and I'm getting, let's say, cash 1,25,000. Because net asset means total asset minus total liabilities. Now try to understand. You sold one property, plant and equipment which has a net book value of 1 lakh. So obviously that will reduce the net asset. You sold it for 125. That 125 will increase your net asset. Is that clear to everyone? This will reduce your net asset. This will increase your net asset. And replace with a machine costing 3 lakh. Now listen. New machine will increase my net asset. But at the same time, I have bought this 3 lakh. Now, let's say, even I bought this machine on credit, I will have to reduce the entire 300,000 because I'm working on net assets. Either I have given cash or I bought this machinery on credit. In both the cases, this 300,000 will have no impact on net assets. Let's say I bought it for cash. Even I bought it on credit, I will have to deduct the 3 lakh because we are working on net asset. So new machinery will increase your assets. Then if you have paid cash, it will reduce the net asset. Even if you have taken that on credit, still the 3 lakh will reduce your net asset. Okay. A full 20% depreciation charge is charged on machinery in the year of purchase, but no charge is made in the year of sale. They have given their accounting depreciation policy as well. It's the company says whenever we are buying a property, plant and equipment in the year of purchase, we depreciate the asset fully, irrespective of the date of purchase. But whenever we are selling the asset, again, irrespective of the date of sale, we do not depreciate in that year. So in the current year, they bought a new machine for 3 lakh. I'll take 300,000, 20% of this, the depreciation will be 60. Now listen to me nicely. This 60 will reduce your net assets, and obviously the same 60,000 depreciation will also reduce your operating profit because it is categorically mentioned in the question. They did not deal with the depreciation at all. So what this 60,000 will do? The 60,000 will reduce your net asset as well as this 60,000 will reduce your operating profit as well. Now we can have the total of net asset and the operating profit also. Let me use the calculator. 2,80,000 plus 25 minus 60. Students, I am getting operating profit 2,45,000. Now let's see the net assets. 2 million. Okay. Let me check the zeros. It has to be 6 zeros. Okay. 2 million plus minus, my bad, minus 1 lakh plus 125. Obviously plus 300,000 minus 300,000, no impact, minus 60. Students, net assets. Net assets, I am having 19. Where should I write? I'm writing here 1965000. I want please at least one or two more students should confirm this. Let me recheck as well. Minus 1 lakh plus 125 minus 60,000. Let's see what the students are saying. Okay, everyone is having the same. Okay, fine. So now students, here comes your return on investment. 245 and net asset is 1965000. If you do not get the exact answer, then always go to the closest one. I'm getting 12.468. So obviously the closest is, so students, the right answer is B. I hope it is clear to everyone. Now, student, I want everyone to attempt this question number 10, and that's the last question of today's class. But don't worry, coming two classes, they will be very long. Because let's see who will give the answer of question number 10. Okay, students are replying. Let's see. Anyone else? What is the plastic division's residual income? Plastic division residual income, okay? The plastic division of Ladmar has just reported a divisional return on capital employed 30% for the last 12 months. The capital employed in the plastic division is 1.2 million. Return on capital employed is 30%. Capital employed in plastic division is 1.2 million, and we need to calculate plastic division residual income, okay? So first of all, very easily we can calculate operating profit of plastic division. Capital employed is 1.2 million. Take the 30% of this. Operating profit is 3,60,000. Student, from this 360, we just need to deduct imputed interest, notional cost. The company's overall return on capital employed is 18% and overall cost of capital is 14. The plastic division cost of capital is 13%. And we are right now working on plastic division. So for us, the relevant percentage is 13, not 14. So simply less imputed interest. $1.2 million. We'll take 13% of that. 1,56,204. I hope majority is having the same answer and the correct answer as well. Let me check. Yes, majority is having the same answer, and the good part is not only same, plus the correct answer as well. Okay, now student, listen to me carefully. As I mentioned earlier, that coming two classes, one is going to be on Saturday, inshallah, another is going to be on Sunday. Those classes will be, of course, long classes, then of course the first class. And plus the coming classes, they will be uploaded on the portal only. First class, there is a possibility we might upload on the portal as well. But let me tell you, the same crash courses are available in SBR, ATX, and AFM as well, and of course FM as well. All the in each paper you can get the best and finest crash courses. And one more thing, where I want to end this today's class, student. Whenever anyone joins Abeel School of Accountancy in our regular classes, on a very first day, we provide a study planner to our students. That study planner gives you a target that every day what you have to do. Plus, we provide the fastest WhatsApp support in the world you can ask from our enrolled students. Normally, we reply within 3 to 5 minutes. We do not keep any teacher assistants. Always your queries are responded by the teacher, not any teacher assistant. And we provide two types of notes. One is detailed notes, another short notes. And we do conduct your final mock as well, which I'm going to personally check, and you can get the personalized feedback on that mock. So students, that is all about first, I would say, class of crash. Inshallah, the second class is going to be tomorrow, and that is going to be a longer class. Thank you very much that you people have taken out time for today's class. Hope to see you and others in the coming classes as well. Thank you very, very much. So students, try not to miss the coming classes as well. Try not to miss the coming classes as well. Thank you very much.